What is going on, everybody? This is John Barr with Prime Homes bringing you the new November 2018 Investors Digest Market Update. Thanks for tuning in. I know it's right here at the end of the month, but had to wait for some data to come out, and I'm glad I did. Some good stuff this month, so we'll go ahead and get right into it. October numbers review, the average sales price is $257,855, which was just under 7% increase year over year. Median sales price stayed the same as last month at $210,000, but it's a 5.4% increase year over year. Total sales is up from this time last year, 7.3% to $2,573. Average rental price really skyrocketed this last month, or from a year over year standpoint, to $1,444, which if you remember right from last month, we actually had a drop in the average sales price. No surprise to see this make up some ground, but that's a really good indication to see the average rental price coming up at 3% to kind of make up from the loss from last month. Employment sitting at just over 1.14 million people, which is a 1.58% increase year over year. That's just under 6,500 jobs gained from the previous month, so that's good. People working in sanitary, that's awesome. Unemployment really dropped down to 3.08%, which is 0.21% decrease from the previous month. So unemployment is still at those historically low levels, and it actually even dropped even further. Month's inventory for October were 3.99%, which is a 0.12 decrease from the previous month, which is typical, and I would kind of see that happen come December as well, to drop it even a little further because everybody's trying to get into those houses before the new year. Median sales price, you can see this on a timeline over the time. If you're just seeing this, what you're seeing here is the cycles. It's up and down, up and down, up and down. So best time to be listing a house to get the most interest in your house and to potentially get the highest price is going to be that April time frame. So if you're doing your rehabs and you kind of buying right now, so you can get those things on the market in that April, May, June, July time frame, so you can get those highest prices. What I am kind of watching here as the last couple of years, it's getting a little more volatile in the prices, the way they're kind of jumping around up and down, but we are still continuing to go up. And I would expect to see December kind of tick up a little bit, November and December tick up a little bit as it has in the past. You can see in these bottoms, and then drop off into January as we go into the cold months and rise into the summer. Monthly rents, same thing. They rise in the summertime, fall in the winter. Rise in the summertime, fall in the wintertime. So if you're a landlord out there and you're doing some buy and holds, structure your leases. You're the landlord. You can do what you want. Structure your leases to where they're coming up for renewal always on that April time frame. I have a property right now that is for rent, and I told the property manager, it's like, hey, that first lease, they can either do, it ends in April 19, or they can sign a lease all the way through April 2020. But I do not want to sign a year lease, so if this tenant ever leaves, right in December again, I'm waiting for a new tenant. So I want to get them on that April timeframe schedule, the April, May, as I can catch the higher prices for those, or the rents to increase. Now, 20-year unemployment, this is where I was saying is, like, you can see we're at a historical low. I mean, we really haven't been this low since the late 1990s, right before the dot-com bubble, and that's what you're seeing here is dot-com here, down, and then through the real estate recession. Why I track this stuff is because how fast these unemployment rates can increase. So real estate really didn't bottom out till right around 2011. And the crisis started in 2008, 2009 is when, like, the real estate or stock market really bottomed out. So real estate always follows the other financial markets. So it's something that I want to track. So if they start skyrocketing again, I'm going to kind of start sounding the alarm, like, hey, something's going on. Now, we do have had some spikes where it goes up 0.5% or more in a single month, but it always has come back down. So now if I see 0.5% and it continues to rise like we did here in the last real estate recession, or the financial crisis, I would start to expect to see that eventually start rolling over into some real estate values. So now, year over year appreciation, I had been saying, you can see how fast this turns around as far as prices dropping. Like I said, right here in 2011, 2012 is right when the prices really bottomed out, and you can see how quickly they turned around and started shelling off positive numbers, and some of them hitting 8, 9, 10, 11, 12, or not quite 12, but 11%. and I thought it was kind of slowing down some, but now we've hit some 8s, some 9s, and this last month we were back up at almost 8% again. So is it slowing down? I don't know. It's definitely giving indication that it's kind of we're hitting some lower lows, not quite as high highs, but we're still getting up there as far as the median sales prices go, as far as from an appreciation standpoint. So now the question becomes, San Antonio is like, as long as we're growing and people are moving here and people are getting paid, every now and then you'll see I'll post on the hourly wages, and we have been increasing in San Antonio. So as long as wages are going up and people are getting employed, staying employed, and businesses are growing, then we can sustain the sales prices that we have seen over the last several years, and they continue to increase. I don't know if it can increase at 8% because wages are only increasing at 1, 2, maybe 3% at the best, and the business growth is sitting right here at right around 2.2%, which is still below our long-term average. But if those stay low, eventually houses can't physically go up because buyers just can't afford them. You're eventually going to hit that shelf. So now the another thing we look at is like affordability problems. And so you can see the long-term trend right around here in 2008, 2009 that affordability was really high. You could get they were affordable based on median household incomes. But now, ever since coming out of the recession, you can see it really starting to drop. Now, like I said, the black line is the United States and brown is San Antonio. So this is continuing to drop and drop and drop and drop. So we're right around that 55, 60% in that range. So if that continues to drop, we're still much higher than where we were right before the last housing crisis of down in like the San Antonio in the U.S. down in the 40s and 50s. So we're still sitting in the 50s, 60s. So that's still better than we were, but something definitely to kind of keep a watch on and see, is it going to be causing problems? Because San Antonio traditionally was a very affordable city. Well, you can see here based on the median household incomes for what jobs are here, that affordability is dropping, and it can become an issue if the prices continue to rise at the consistent rate they have been. So now the most popular section is for your real estate investors is like, where to market, where do I send my direct mail, where do I want to try to buy properties, what am I looking for? So now I break this down by two ways, by price range and by zip code, to see where the most in-demand housing is in San Antonio. And I have to apologize, I just realized there must have been a mistake here, because you're not going to see an even 10.38 all the way across. But what is accurate is the months of inventory. And where is the most in-demand housing? Where are people wanting to live? Where is the most demand for buyers? Which high demand for buyers means, and low inventory means the prices are going to increase. So no surprise that where home builders building homes in San Antonio, they're in the 200, 250, 220, 275 price range. They're not building houses below the 200,000 price range, which is a very affordable price range to be buying in. So how do you really compute the months of inventory is, so you can kind of get a grasp on it, is if no new houses were listed on the MLS and the same number of houses were sold in the previous month continued, that means for the $150,000 to $200,000 houses in the San Antonio area, it would take 2 months for all housing to completely disappear, not have any houses on the market. That's extremely fast. The average market is 6 months, and we don't hit 6 months right up here to 400, 500,000. And they say 6 months is a balanced market between buyer and seller, which no real party has any more negotiating power than the other. Anytime that number starts to drop, that means that the seller has a little more negotiating power because it's a very in demand. The lower that number gets, the more power that buyer has, because the buyers can't, or the more the seller has, because the buyers just physically can't negotiate because there's not a lot of inventory, there's not a lot of choices, and things are moving very quickly. So for us, we like to stay in that sub $250,000 price point just because the month's inventory are much, much lower. Now, the other way I break this down is by zip code. So now we are in November, so next month is going to be a 2-year mark from when I first started doing this zip code, breaking it down by the zip code, so you can see what the appreciation has really been over the last 2 years. But you can put a kind of visualization to what these low months of inventory really mean as time moves on. So here, the zip code this month, the lowest one is 78239 with 1.71 months inventory. And remember, no new houses got listed, the same number of houses got sold. This is how long it would take, 1.71 months, for all the houses in that zip code to be sold out. And back in December, the average median sales price was $151,000. This month, it's $174,000. So it's almost $23,000 in appreciation in just 2 years. It's quite a good return on some investment there. But that is what low months of inventory can really do for an area. So if you're trying to target an area and trying to buy property up in these zip codes, is going to be a pretty good bet that they're going to be safe and people are going to want to continue to live in these areas, and prices can still increase. Now, the inverse side of that is where are the worst zip codes. Now, not to say these are bad zip codes by any means at all. It's just to say that be cautious when you're trying to buy something in this area, you're trying to renovate, especially if you're fixing and flipping, that what the months of inventory are and what your competition level is. And it's no surprise to see a lot of these up in the much higher price range of 280, 418, 420, 405, up in the 600s as far as highest months of inventory. So if you are renovating in that area, be looking at what your competition is, and maybe you need to spend a little extra in the kitchens and baths and putting some higher end materials, staging pictures to make sure your house is not the one sitting on the market for those 5 months of inventory, or sitting on the market for 5 months. Make sure you're in 2 months. Because if you got a hard money loan and you're renovating a house at $420,000, each interest payment every single month, that like clockwork, is going to come straight out of your bottom line. But you can get bigger profit margins in these areas, because 20% is much nicer of a profit on $400,000 than it is on $150,000. But it can sit on the market longer. So keep this stuff in mind when you are looking at your properties and wanting to renovate. Well, that's really it for this month's market update. I appreciate you guys tuning in. If you have any questions, feel free to shoot me an email at john@primehomes.com. Make sure you pop over and check on whatever platform you like to listen to our podcast on Investor's Journey about tips and tricks and things that we do to manage our business and things we've kind of learned along the way in our investing careers. And you can find all that stuff at primehomes.com, or you can kind of give us a shout out on Prime Homes, very active on Instagram and Facebook. Well, until next month, happy investing.